To break this losing streak, it looks like, right? We've been down 8 straight weeks in a row on the Dow. We've been down 7 straight weeks on the S&P and the NASDAQ. It's sort of been a nauseating decline to watch. Are we turning the tide in any way?
I think we probably have. So you know me, I've been pretty unenthusiastic for a really long time, like more than a year I've been unenthusiastic. And I would say I'm enthusiastic now. I'm feeling pretty good. We've done a lot of work in the last few months. The valuation of the S&P 500 has gone from 21.5 times to 16 times, 16.5 times. That is a ton of hard work that's gotten done. Even if it declines more, maybe we go down to 14.5 times. I don't know that that's likely, but that's only 2 more multiple points of contraction. Also, as I've been thinking about all of the things that have dragged the market down over the past earnings season announcement, it's been major negative announcements. Amazon, Walmart, all of these. We're almost done with earnings season. So I think either we're done and we rally or we bump along, but I strongly suspect that the worst of it's done.
All right.
Also, adding to my enthusiasm is I am comfortable and confident buying new companies right now, which is another thing I haven't been for quite some time.
Interesting, and we'll get to that. By the way, I mean, stocks are at the highs of the day. Let's note that. Jason Snipe, is it time to be more, as Jenny says, enthusiastic?
So I think we can be. I think when I look at the Fed minutes from this week, and the theme that resonates with me is kind of peak inflation and peak Fed, right? So I think really what the street has taken away from the commentary is that the Fed is going to be data dependent. They're definitely going to move in June. They'll definitely move in July. And then we're going to take a look and see what's going on. And to Jenny's point, the street has done a lot of the work. The market has done a lot of the work. If you look at the multiple, as she already mentioned, at 16 times the S&P from 21, I mean, that's a lot of work. You look at the bond market and what it's already done. So I think this is an opportunity to leg into some names that have been beaten down. Obviously, the market has been down, but it's nice to be on with some green on the screen. And I think there will be some opportunities, especially with companies with free cash flow, and obviously pricing power in this market. I think are names to look at here.
I mean, it is amazing, Doc, how the mood changes when there's green on the screen. For a handful of days, everybody all of a sudden sounds a little bit more positive on things, even though I'm not sure what's changed all that much. But nonetheless, let's go with this for a little bit. Citi says it's time to buy the dip. Now, they may be more enthusiastic about Europe and the EMs over the U.S., but nonetheless, is it time to put money to work in the market, Doc?
Well, I think we're probably within 2 to 5%, Scott, of whatever the tradable bottom is. And most people, I'm sure virtually everybody on the panel would agree that you don't want to time the market to that extent. If you think you can really wait until you finally get that capitulatory bottom, you may very well miss it. And by the way, I think right now, and people feeling better is because of what the Fed was talking about yesterday, Scott. Jenny's right. And so is Jason. The market has done a lot of the real hard work for the Fed here because they've both beat up stocks and the bond market has, jumped interest rates. But now that is starting to reverse. Interest rates have come back down pretty dramatically, really, given what is likely to be coming our way here in the June meeting. We're going to see another 50 basis point move. But why are you not seeing that scaring the market? Because they've already priced it in, Scott. So the question after that June meeting will be how soon into the next meeting do they start talking about maybe 25 will be enough rather than 50? And that's, I think, part of what the market's reacting to here. Yeah.
I mean, maybe you mentioned bonds. I mean, maybe the bid in bonds has helped soothe the market in some respects.
You bet.
Too. Anastasia, you're advising your clients to buy the dip. Not trying to call a bottom, but nonetheless, you see what's going on. And what are you telling people?
Well, first of all, I would agree with Jenny and the sentiment here that there's a few things to be encouraged by. And the first one of them is just in the last 48 hours, it seems like we're starting to get an adjustment in attitude from the Fed that maybe they're willing to be a little bit more patient and moderate the pace of rate increases once we get through the next couple of meetings. So that's really, really critical, because the market fear that the Fed is going to continue to hike into a slowdown and generate a 70s kind of scenario. But if they're not, maybe this doesn't end up being a late cycle recession and a crash landing. Maybe this ends up being a soft landing and a mid-cycle pause. And if that's the case, then the stocks are viable from these levels. So the magic about 16.5 times multiple that Jenny mentioned is that that's what the multiple on the S&P was before the pandemic, when the Fed funds rate was at 2.5, 2.25%. So that might actually be our fair multiple, Scott. And I think it's interesting that the stocks have been holding this 3,900 that you and I talked about on overtime. They've been holding this level and rebounding off of it. So yes, I think for investors, I'm not saying, trade for the next 5% over the next couple of months, but I'm saying for investors who are looking more long term, the time you want to buy stocks is when it feels terrible to do so, when there's a lot of uncertainty and when the multiples are lower. And if we look at the multiples, if you're buying a 22 times multiple, historically, you probably have not made money on a 1-year forward basis or even a 5-year forward basis. But if you're buying at 16 times multiple, that's a different story. Historically, 1-year forward returns have been double digits.